Hey folks, it's Iggy from the Investing Iguana. Have you ever stared at a double-digit yield on a Singapore REIT and thought, free income, right? Not so fast. Today, we dig into the real story behind those high yields. We'll unpack which high-dividend REITs are sturdy income machines and which are classic yield traps waiting to snap shut. If you invest through CPF, SRS, or your own cash, hang on. This will reshape the way you look at REITs. This video is adapted from my latest in-depth Substack deep dive, Singapore's high-yield REIT trap, why double-digit yields demand your caution. The link's in the description below. For those new here, I'm Iggy, your guide to the Singapore investor jungle. I break down complex finance into bite-sized Singapore-relevant insights, sprinkled with local wisdom. Here's what we'll tackle: the high-yield danger zone, top 10 REITs and their risk cheat sheet, the yield trap warning signs, my grab-and-go checklist, Singapore's REIT quality spectrum, finding CPF SRS-friendly names, sector risks that move the needle, the total return reality check, why interest rates are the hidden villain, the SG Investor playbook to put it all together, and finally, my personal verdict, plus a decision checklist you won't want to miss. Let's get started. The high-yield danger zone, top 10 analysis. Let's hit you with the numbers. When you see Singapore REITs flashing 8, 9, or even 11% yields, don't cheer. Investigate. Why is the yield so high? I show a table summarizing the top 10 yielding REITs and run a risk lens right over them. Top of the leaderboard, Asian Pay Television Trust, APTT. Big yield, but the business is shrinking. Debt is high, and the payout is shaky. A textbook yield trap. Compare that to Keppel Infrastructure Trust, KIT, hovering around 9%. Keaton's key assets serves needs everyone relies on and keeps his debt manageable. That's a rare high yielder that could actually hold up through tough times. Office-focused IT Global, decent yield, but European offices have their own headaches. Vacancies and debt refinancing in a changing market. When a yield is sky high, are you seeing a gift or a warning flare? The yield trap warning signs. Don't just memorize the numbers, memorize what they're signaling. I use a fast filter checklist that you'll want to borrow. This visual breaks it down. Is the business model stable or disappearing? High debt, short-term loans? Is the DPU, that's dividend per unit, at risk from currency swings? Are payouts too high to be sustainable? APTT checks almost every warning box: shrinking business, high leverage, currency risk, and payout stress. KAT passes more filters, though keep an eye on their interest repayments. If you spot 3 or more red flags, the high yield is likely just a risk premium in disguise. Next time you see 10% on a REIT, ask yourself, what am I getting paid for? Quality versus yield. The Singapore REIT spectrum. In Singapore, normal is middle single-digit yield. Anything running 7% and a strong balance sheet is miles better than 10% with looming debt trouble. I lay out a table splitting REITs into buckets. Defensive core, CPF, SRS friendly. Balanced income. Think quality logistics and infrastructure, and high yield. Overseas or niche, higher risk. The checklist? For CPF/SRS, stick to defensive and balanced. Leave the risky stuff for side bets with tight controls. Would you rather drive a reliable Toyota every day or a sports car that might break down on the PIE during rush hour? Sector risk assessment framework. Every top yield REIT rides on sector-specific risks. I share a matrix. Imagine a quick map connecting each sector to a type of risk. Infrastructure, strong foundations, needs-based demand, safer. Paid TV, deep decline, business model is aging. Danger zone. Office. Can survive if top tenants and leases are long. Logistics. Only pick the best, high occupancy names. So don't just chase the yield. Ask, what sector risk am I swallowing? Would you eat the same food for every meal just because it's cheap? Or do you think about nutrition too? The total return reality check. Chasing a 9% yield? If the REIT's price slides 50%, you just burnt years of income. We need to focus on total return. That's yield plus price change. Practical lens for CPF/SRS. Anchor on survivor REITs that can outlast downturns. For cash portfolios, add just a slice of high yield, but size it right and demand strong balance sheets. A table here visualizes how, under bad scenarios, defensive core REITs survive while high yield gets hammered. The math is simple. Can the DPU hold up if the economy stays flat and rates remain high? Quick plug. If you want all the detailed tables, checklists, and full written strategy, grab this full post on Substack. Link below. Interest rate sensitivity. The double-edged sword. Here's the hidden villain. Funding costs. REITs rely on borrowed money, and higher rates squeeze their profits. The chart I show ranks risk. What matters isn't just how much they owe, but when and how their debt matures. 3 things to track. Weighted average debt maturity, longer, ICSM better. The mix of fixed versus floating interest rates. More fixed is safer. Interest cover ratio. Higher here means more breathing room. If the MAS cuts rates, quality REITs bounce first. Weak ones lag behind, lenders stay cautious. So, are you tracking yield or are you digging under the hood for balance sheet red flags? Strategic investment approach. This is my hands-on framework. Picture a template mapping each investment bucket to its job. CPF/SRS, hunt for defensive and balanced names. Steady cash flows, low to mid leverage, long-term debt. Cash income, add a focused sliver, maybe 10 to 20% of high yield, but only if your fundamental screen is strict. My rules of thumb for any REIT, gearing below 40%. Interest cover above 3x. Minimum 2.5 years debt maturity. Over 70% loans should be fixed rate. Run, don't walk, from payout ratios above 90%, unless there's a safety buffer. And always, prefer what you can underwrite. Infrastructure, top logistics, retail with good tenants. Be wary with overseas offices, unless the leases and tenants are strong. And keep some cash dry, because market re-ratings come fast. The best investors prep for the rainy days, not just the sunny ones. The bottom line, quality over yield. Here's my verdict. The final table in the article translates all this analysis into action steps. Avoid the fragile models. APTT's tempting payout is only skin deep. Consider the rare solid names, but only with clear size and risk rules. Kit and strong logistics names deserve a place. Caution for niche or overseas REITs. Small positions, close watch. I'd build for survival first, yield second. That's the Singapore investor's edge. Are you building a house on sand or on solid ground? Quick recap. From high yield traps to smarter filters to a decision checklist, you now have the framework to navigate Singapore's REIT landscape for CPF, SRS, or your personal portfolio. Take these lessons into your SG investing journey. Go for sustainable income, not just tempting numbers. If this helped, drop a like, share it, and hit subscribe for more plain English, Singapore-focused investing breakdowns. Want all my full charts, tables, and my written playbook? Grab this post on Substack. Links in the description. And if you're ready to raise your SG investing game, check out my premium community. Details below. Don't just watch the markets, outsmart them. For your next step, check my deep dive into how to build a CPF-proof Singapore portfolio. It's the perfect follow-on. Stay sharp, stay Iguana.